Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 128, and in this episode we're reviewing the performance of the global markets during the 40th week of 2024, and that is from Monday the 30th of September to Friday the 4th of October. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where on Friday the Labor Department reported that the U.S. economy added far more jobs than expected in the month of September, pointing to a resilient labor market as the unemployment rate edged lower. Nonfarm payrolls increased by 254,000 in September, up from a revised 159,000 in August, and better than the consensus forecast of 150,000 new jobs. Meanwhile, the unemployment rate dipped by just 0.1% to 4.1%. With upward revisions from previous months, the jobs report eases concerns about the state of the U.S. labor market and probably indicates that the Federal Reserve will opt for a gradual pace of interest rate reductions. And over to the Eurozone, according to interim data released on Tuesday by Eurostat, the rate of inflation in the Eurozone fell to 1.8% in the month of September, which is below the European Central Bank's target rate of 2%. The inflation reading came out in line with market expectations after the annual rate of inflation hit a 3-year low of 2.2% in the previous month of August. The core inflation rate, which excludes volatile food and energy prices, this came in at 2.7% and was down marginally from 2.8% in August. Moving over to the United Kingdom, data from the Office for National Statistics showed that British economic output grew by 0.5% in the second quarter of 2024, which was slightly slower than the interim estimate that had shown an economic growth at 0.6%. Compared with the second quarter of 2023, the economy grew by 0.7%, which was slower than the consensus forecast of 0.9%. On Wall Street this past week, stocks advanced on Friday after a better-than-expected jobs report gave investors confidence around the health of the U.S. economy. The jobs data confirms that the U.S. economy remains resilient, supported by a healthy labor market, and increases the potential for a soft landing as the Federal Reserve begins to ease monetary policy. Stocks rallied after data showed that non-farm payrolls grew by 254,000 jobs in September, far outpacing the forecast of 150,000 jobs as the unemployment rate ticked down to 4.1%. For the week, the S&P 500 rose by 0.2% to close at 5,751, whilst the Nasdaq Composite added 0.1% to end the session at 18,137, and the Dow Jones Industrial Average ticked up by just 0.09% for the week, but still managed to record an all-time closing high of 42,352. In the government bond market, U.S. Treasury yields jumped on Friday as investors digested a better-than-expected September jobs report. The jobs report points to a solid economy and also signals that the Federal Reserve is more likely to adopt a measured approach in reducing monetary policy. According to the futures market, traders are now pricing in a 91% chance for a 25 basis point rate cut in November. Since the Fed cut rates by 50 basis points in September, the yield on the benchmark 10-year Treasury bond has actually increased from around 3.6% and is now approaching about 4%. In summary, the 10-year Treasury yield rose by about 12 basis points to 3.97%, whilst the yield on the 2-year Treasury note was up by 21 basis points and was last seen trading at 3.92%. In the commodity markets, on Friday, the price of crude oil posted its biggest weekly gain in more than 1 year as traders are fearful that Israel could strike Iran's crude oil facilities in retaliation for Tehran's missile attacks. The price of crude oil spiked about 5% on Thursday after the U.S. president initially indicated that the White House was discussing an Israeli strike on Iran's oil industry, but later clarified that they were discouraging Israel from targeting Iran's oil fields. For the week, the U.S. benchmark West Texas Intermediate crude increased by about 9%, and was trading at $74.38 per barrel. Meanwhile, the global benchmark Brent crude jumped by about 8.4% and eventually settled at $78.05 per barrel. In the precious metals market, the price of gold fell on Friday after stronger than expected U.S. jobs report boosted the U.S. dollar and caused traders to scale back expectations for an aggressive rate cut from the Federal Reserve in November. However, the main theme remains focused on lower interest rates, and therefore bullish sentiment on gold is expected to persist over the longer term. After scaling a record high of $2,685 last week, the price of spot gold was down 0.3% and was last seen trading at $2,647 per ounce. For your information, gold is used as a safe haven asset, especially during times of political and financial uncertainty, and thrives in a low interest rate environment as it provides no yield. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where overall inflation declined to 3.6% in September, down from 4.4% in August, and this was largely due to a significant decrease in fuel prices. Fuel inflation declined to 1.1%, down from 4.7% in August. Additionally, food inflation also declined marginally from 5.3% in August to 5.1% in September. Meanwhile, core inflation, otherwise known as non-food, non-fuel inflation, this decreased from 3.5% in August to 3.4% in September. And on economic growth, according to the Kenya National Bureau of Statistics, the Kenyan economy recorded a growth of 4.6% in the second quarter of 2024, which was slower than the 5.6% growth recorded in the second quarter of 2023. The main contributor to Kenya's economic growth remains the agricultural sector, which grew by 4.8% in the second quarter of 2024, compared to an expansion of 7.8% that was recorded in the second quarter of 2023. The slowdown in economic growth was reflected across all sectors of the economy except manufacturing, wholesale and retail trade, as well as health and professional services. In the domestic foreign exchange market, during the past week, the Kenya shilling remained stable versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the US dollar was quoted at the same rate of 129.19, which was recorded the previous week. Meanwhile, the sterling pound was priced at 170.35 and the euro was valued at 142.48. And on the regional front, one Kenya shilling was changing hands for 28.42 Ugandan shillings and 21.09 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.44. Over the past 6 months, the shilling has been relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak. This is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased for the fourth consecutive week and was up by $159 million to hit $8.18 billion, which is equivalent to 4.2 months of import cover. This level of reserves is now in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing national debt that has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the liquidity situation in the interbank market remained adequate and was also supported through open market operations. Open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this decreased marginally to 12.71%, down from 12.75% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 17.4 billion shillings, down from 19.5 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 21 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 3rd of October, and the central bank received bids totaling 53.9 billion shillings against an advertised amount of 24 billion shillings, and this represents a performance rate of about 225%. The central bank ended up accepting only 29.2 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 3 basis points to average out at 15.68%, whilst the 182-day rate fell by about 9 basis points to close out at 16.49%, and the 364-day rate decreased by 7 basis points and eventually settled at 16.72%. And just as a reminder, in the primary bond market, the Central Bank of Kenya is now inviting bids for its October bond issue, in which it is looking to raise a total of 30 billion shillings for the stated purpose of budgetary support. The central bank is offering for sale 2 reopened fixed coupon treasury bonds, both with an initial tenor of 10 years and whose terms and conditions are as follows. The first bond, initially issued in 2016, has 1.8 years left to maturity and a coupon rate at 15.039%. The second bond, initially issued in 2022, has 7.6 years left to maturity and a coupon rate at 13.49%. Both these bonds are now open for sale until Wednesday, the 9th of October. In the international market, during the second quarter of 2024, the yields on Kenya's Eurobonds were on a downward trajectory, with the 7-year 2019 Eurobond decreasing the most by 2 percentage points from 10.3% recorded at the start of quarter 1 down to 8.3%. At the Nairobi Securities Exchange, during the second quarter of 2024, the equities market recorded a mixed performance, with the NSE 20, the NSE 25, and the NSE 10 gaining by 7.2%, 1.3%, and 0.7% respectively, whilst the NASI declined by 2.2%. This takes a year-to-date performance to gains of 23.4% for the NSE 10, 21.4% for the NSE 25, 17.7% for the NSE 20, and 16.4% for the NASI. The market's performance during the quarter was driven by gains recorded by large-cap stocks such as Bamburi Cement, which increased by a massive 40%, whilst KCB Group and Standard Chartered Bank recorded more modest gains of 11% and 8.2% respectively. These gains were however weighed down by losses recorded by other large-cap stocks such as Safaricom and British American Tobacco, which declined by 13.3% and 2.9% respectively. Up next is our topical issue, and this week we are looking at the diversion of borrowed funds to finance recurrent expenditure. The national government spent more than half of the cash it borrowed in the previous financial year, which works out to about 416 billion shillings on recurrent expenses such as salaries and utilities. According to the Budget Review and Outlook paper for the fiscal year ended June 2024, Out of the 766 billion shillings that the government borrowed from the domestic market, only about 350 billion shillings was used to fund development projects, whilst the balance of 416 billion shillings was spent on recurrent expenditure. On a year-to-date basis, the use of borrowed cash to fund recurrent expenditure increased significantly by about 82%, as it rose from 228 billion shillings in 2023 to 416 billion shillings in 2024. The diversion of borrowed funds to finance recurrent expenditure came against a backdrop of missed revenue targets, as tax collections fell short of the budget amount by about 205 billion shillings. And to add insult to injury, the government increased recurrent expenditure by 430 billion shillings, whilst at the same time cutting its development spending by 109 billion shillings. For your information, the diversion of borrowed funds to finance recurrent expenditure is a breach of Section 15(2)(c) of the Public Finance Management Act of 2012, which dictates that borrowed funds should only be used to finance development projects. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout, and it is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, do not wait for death to remind you how precious life is. Think about it. Thank you, and God bless.